7 De-SPAC stocks to buy now. Special Purpose Acquisition Companies, SPACs, are publicly traded investment vehicles created for the sole purpose of acquiring or merging with one or more businesses. They can be used by private firms interested in becoming public, by family-owned enterprises looking to expand their business, and by groups wanting to pool their resources together without taking on the financial risks of a new venture. SPACs come in two forms: blank check SPACs and SPACs that purchase shares in an already public company. Blank check SPACs are typically created for large companies looking to go public, while SPACs that purchase shares are typically set up for smaller firms who want to merge with another company or sell their assets. In this video, I'll provide you with a list of 7 best SPAC stocks that are currently undervalued and have the potential of making you extremely rich if you're a long-term investor. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. With the rise of unicorns and the mega deals made by challengers, it may seem as if the traditional approach to investing in startups no longer offers an attractive proposition. But SPACs are still very much alive and poised for growth in this new economic climate. Investing in SPACs is a common and straightforward way for investors in the US to get on the ground floor of a company that is about to go public. My list of best SPACs to buy comprises of only De-SPAC companies, i.e. former SPACs, that have already concluded their merger process and are now trading under their new name and new ticker symbol. These former SPAC companies are trading at reduced risk levels with the potential for higher rewards in the future. Without much further ado, here's my countdown list of 7 best De-SPAC stocks to buy now. 7. Paysafe Limited, ticker symbol PSFE. Current price $7.68. Paysafe is a leading global iGaming payments platform whose stock has dropped in value in 2021. Its stock is only 3 times next year's revenue. This stock with iGaming and payments exposure appears to be undervalued at a low single-digit revenue multiple and less than 10x EBITDA multiple. Investors will reason that the stock is properly valued if we dig deeper and evaluate the core business. There are a few main factors at the heart of Paysafe. On the negative side of the equation, we can see that Paysafe is forecasting slow growth. On the plus side, we can see a corporation with strong bottom-line profitability. Paysafe is continuing to extend its footprint in North America, a market that is predicted to grow at a 55% compound annual growth rate, CAGR, to more than $40 billion by 2025. Furthermore, the amount of iGaming transactions in North America increased by 72% year-over-year in Q2 2021. Paysafe is emphasizing to investors that it is aiming for EBITDA growth in the mid to high teens. For a corporation that is forecasting EBITDA of just under $500 million this year, this means that Paysafe's EBITDA will be close to $570 million next year. Given Paysafe's current market valuation of $5.6 billion, this doesn't appear to be overly pricey, as investors are being asked to pay less than 10 times next year's EBITDA. Paysafe is valued at just 3x forward sales, based on these figures and projected sales through 2022. The stock appears to be cheap when compared to a slew of other iGambling or fintech companies in this industry. 6. Avapoint, ticker symbol AVPT. Current price $9.28. Avapoint suffered in its first few months of public trade, with shares down approximately 25% since the SPAC merger. Avapoint specializes in Microsoft 365 data management solutions for companies all around the world. The company provides a range of SaaS solutions for data migration, management, and protection. In addition, the company offers hybrid on-prem and cloud solutions for Office 365, Salesforce, and Dynamics 365. Advice and implementation, maintenance and support, Microsoft Teams, Surge and Advisory, Migration as a Service, and Quick Start services are also available. The stock has had limited volume since the merger with Apex Technology Acquisition Corp., resulting in a steady fall in share price. Avapoint could see possible tailwinds pulling them forward in the not-too-distant future as SaaS and big data continue to expand. Based on comparisons to peers and Wall Street analysts, Avapoint's valuation could easily offer a potential upside of up to 50% from present prices and a possible loss of up to 10% if support holds up in the face of any macroeconomic headwinds. This is an attractive investment opportunity for a stock in the profitable SaaS and IaaS businesses, both of which are predicted to rise by double digits for the foreseeable future. Avapoint trades at a 9x earnings EV to revenue ratio. This is significantly lower than peers, implying that the stock is trading at a 50% discount to competitors. In comparison to rivals such as Alteryx, Jamf, and Avalara, which trade at substantially higher multiples despite similar financials, Avapoint looks like a red-hot deal with a market cap of just $1.7 billion and estimated revenue of $257 million for next year. Avapoint is well-positioned to prosper and join the likes of Datadog, Alteryx, and Dynatrace. Earnings will take time to get out, and momentum will take time to build. The company's presence in a number of high-growth, huge total addressable market categories, such as data transformation and cloud SaaS, makes it a solid long-term investment. Strategic alliances with companies like Microsoft lower the risk of investing in Avapoint. 5. Evgo Inc., ticker symbol EVGO, current price $9.95. Evgo is the world's largest publicly accessible fast-charging network. As of September 30, 2020, the company operated over 800 DCFCs with a capacity of more than 44 kilowatts, accounting for about 40% of the market. The company plans to have built over 16,000 fast chargers by 2027. It's a 20-fold growth from 2020, and it's growing at a CAGR of more than 50%. It just signed a contract with GM for 2,750 fast chargers, bringing it one step closer to the goal. Evgo has been publicly traded since July 1, 2021, by entering into a business combination with CRIS, a SPAC. The stock price has been declining since its initial public offering. Because it is still in its infancy, I believe investors are concerned about the uncertainty. Evgo could be a terrific way to take advantage of the automobile industry's rapid advancements. The adoption of electric vehicles is the primary driver of change. Despite this, because the business is still in its early stages of development, the present market pricing does not reflect favorable outlooks for electric charger services. The company's current market capitalization is barely $707 million. My analysis shows that the stock price is now cheap, implying potential capital appreciation with low risk. I believe we can profit from the fastest expanding market for the next 10 years by taking advantage of the current mispricing. According to the most recent earnings presentation, revenue was $4.7 million in the second quarter of 2020, with a net loss of $18.4 million. Furthermore, capital expenditures in the first half of 2021 totaled $23.3 million, which was 3 times higher than in the first half of 2020. Young growth enterprises are characterized by low revenues from unused assets, negative margins, and significant capital expenditures, which provide proactive investors with investment opportunities. The rising number of electric vehicles and favorable government policies are key drivers of charger expansion. Furthermore, because not every EV owner can afford private chargers at home, demand for publicly accessible chargers will rise. Evgo is currently the market leader in pure-play electric vehicle charging stations. Over the next 10 years, I believe it will maintain its exceptional position in the face of fierce competition. 4. Gengo Bioworks Holdings Inc., ticker symbol DNA, current price $14.20, with a market cap of $17.8 billion. Gengo Bioworks Inc. and Soaring Eagle Acquisition Corp., a special-purpose acquisition firm, agreed to merge in July 2021, creating the newly listed Gengo. Gengo Bioworks is a high-growth analytical biotechnology firm that uses automation and a combination of computational and synthetic biological processes to perform contract-based cell engineering. Gengo provides services to a wide range of industries, including chemical, pharmaceutical, industrial, food, and energy. Gengo is one of the fastest-growing biotechnology firms, with a projected 4-year CAGR of 84% and net revenues of $64 million in 2020 across their 70 key customer programs, on top of an expected net loss of -$126.6 million. For people who aren't conversant with molecular biology, Gengo Bioworks' product list is a maze. It primarily focuses on contract-based cell engineering that combines computational and synthetic biology approaches to target the $2 to $4 trillion developing market for bioengineered goods, which includes enterprises in the industrial, culinary, consumer, and pharmaceutical sectors, among others. Gengo's co-founder and CEO is Dr. Jason Kelly. He is a creative thinker with a strong sense of action, who learned synthetic biology during his PhD in bioengineering at MIT. He finished his degree in 2008 and began working at Gengo shortly after. At Gengo, he has a stellar track record. He has guided the company through key collaborations with Bayer on microorganisms for self-fertilizing crops, Roche on next-generation antibiotics, and Motif on animal-free protein components, to name a few. Gengo was founded in 2009 and now employs over 600 people. Gengo is one of the industry's top performers, with an unrivaled 4-year CAGR of 84% expected to exceed $1 billion in revenue by 2025. It has a high entry valuation, however it is less so when compared to its narrow peer group. Gengo is unquestionably a good buy, but the question for investors is at what price point? Despite the fact that I am a huge fan of Gengo, I believe the current stock price is a little too high right now. I'd wait for a significant pullback, if we're lucky, before investing in the company. Anything under $10 is seen as a good starting point. 3. Proterra Inc., ticker symbol PTRA, current price $11.48 with a market cap of $2.4 billion. Proterra Inc. is a significant manufacturer of commercial electric vehicles in the United States, with a 10-year history of producing transit buses. Over the last decade, the business has advanced the technology to the point that it now supplies end-to-end solutions for other manufacturers, including performance batteries and drivetrains, as well as building fleet-level chargers and energy management systems. As governments around the world continue to require zero-emissions standards for medium and heavy-duty trucks, commercial vehicles represent a high-growth area of EV yet in the early phases of electrification. Proterra recently became publicly traded as a result of a SPAC merger and has a strong management team and financial strategy. We are bullish on the stock, which we feel is cheap in light of its substantial growth potential and long-term potential. On August 11th, Proterra announced a record quarterly sales of $59 million, up 39% year-over-year. Significant investments in capacity expansion continue to be the narrative, with a focus on battery, vehicle, and software development. While the company is still losing money, management emphasizes that this was the 6th consecutive quarter with a positive gross margin of 2.2%, which is likely to rise in the future. In comparison, the adjusted EBITDA loss of negative $21 million in Q2 2020 was minus $15 million. The SPAC merger with ArcLight Clean Transition Corp., which occurred on June 16, resulted in a cash balance of $762 million at the end of the quarter, compared to about $91 million in long-term debt. The company is properly funded, according to management, to fund growth until it reaches positive free cash flow in the coming years. In order to put things in perspective, operating expenses in the second quarter totaled $31 million. Proterra delivered 54 buses to 15 different transit clients in the second quarter, including 6 new ones. With production facilities in Los Angeles, California, and Greenville, South Carolina, the company can presently create roughly 680 buses per year. In June, the business announced a contract with Miami-Dade County in Florida for 42 ZX5 plus electric transit buses, as well as a battery storage system and 75 chargers, to be distributed among 3 bus depots. The contract, according to Proterra, is a landmark project that will serve as a model for other communities. Proterra expects total revenue to reach $246 million this year, up 25% from 2020. The gross margin is also expected to stay healthy, according to management. The company's main message in the earnings news release is that the outlook for the North American electric transit bus market has never been stronger. 2. Payoneer Global Inc., ticker symbol POYO, current price $7.79 with a market cap of $2.6 billion. Payoneer delivered a strong first quarterly report as a public company after concluding the business combination with the FTAC Olympus SPAC at the end of June. Unfortunately, some of the COVID normalizing data were overstressed by the market. I'm still bullish on the stock below $10 as the payments company continues to exhibit impressive long-term growth prospects of more than 20%. Despite the fact that the stock has struggled since coming public, Payoneer recorded a 42% increase in revenue in the second quarter and is forecasting an increase in revenue for the year. During the quarter, the global payments organization set a new revenue record of $111 million and processed $13.6 billion in payment volume. Payoneer's quarterly figures are perplexing because payments took a severe hit in Q2 owing to global lockdowns, which cut payment volumes while take rates dropped due to higher take rate overseas travel collapsing. The good news is that take rates are increasing as Payoneer expands into higher margin areas like commercial cards and working capital, and a potential resurgence in foreign travel will serve as a growth stimulus. Payoneer, on the other hand, is on course to achieve yearly revenue growth of 20% or more, with adjusted EBITDA margins above 20%. For example, a 20% increase in revenue next year would result in revenues of $534 million and normalized EBITDA profits of over $106 million. Keep in mind that these figures are only intended to serve as a starting point for future growth. Payoneer and Coupang, one of Asia's top e-commerce companies, have announced a new relationship that will allow hundreds of thousands of sellers from around the world to expand and sell more simply in South Korea. Sellers on Coupang may now enjoy more smooth payments for their cross-border enterprises by leveraging Payoneer's technology and expertise to boost Coupang's payments capabilities. As of the second quarter of 2021, Coupang had over 17 million active clients and produced $15.6 billion in revenue in the previous year. 1. Origin Materials, ticker symbol ORGN, current price $7.22 with a market cap of $1 billion. Origin Materials is the most valuable stock on our list for a reason. Origin Materials, a disruptive materials technology leader, joined with SPAC Artius Acquisition Inc. in June to form the first publicly traded carbon-negative materials chemical firm. The exciting thing is that Origin Materials is a new era materials firm that extracts chemicals from plants and uses them to create a more environmentally friendly version of plastic and other items without the use of oil. Origin's decarbonizing technology is expected to change the production of a wide range of end products, including clothes, textiles, plastics, packaging, car parts, tires, carpeting, toys, and more, addressing a $1 trillion market potential. Their goal is to help the world make the transition to sustainable materials. Their patented breakthrough platform technology for generating recyclable and sustainable materials allows them to achieve net zero. PepsiCo, Nestle, Danone, Ford, Primaloft, Mitsubishi, Palantir, Bioindustrial Innovation Canada, and others are among Origin's partners and customers. Origin's innovative technology is ready to use, and it can be used to replace fossil resources in a variety of common items. Origin's technique is predicted to be cost-competitive with petroleum-based materials and a fraction of the cost of other technologies, because it uses ingredients sourced from abundant non-food sources, wood residue. Origin Materials, which was founded in 2008, went public on June 25 following the approval of its merger with Artius Acquisition. Despite a flurry of fresh customer updates and more transparency that have considerably enhanced the company's fundamentals, Origin's stock has been pounded since the company announced it finished its De-SPAC. Despite plenty of positives, the market is treating Origin like a regular SPAC, and the stock has been reduced in half. The stock price has risen from its 52-week low of $5.12 to its current level of $7.22 at the time of recording this video. Origin Materials released its first quarterly results in August, following its Nasdaq public listing in June. Origin Materials has boosted the number of signed offtake agreements and capacity reservations to $3.5 billion, up from $1 billion in February. The loss in adjusted EBITDA for the second quarter was $3 million, compared to $1.6 million a year ago. In Q2 2020, net income was $62.5 million, compared to a loss of $1.7 million in the previous quarter. EPS on a GAAP basis was 63 cents. When compared to competitors, Origin's pulpwood feedstock clearly gives the company a significant competitive advantage. On the operations side, Origin Materials has lifted and installed all its previously fabricated key production modules for its first manufacturing plant, Origin 1, 6 months ahead of schedule. According to the company, the factory is on schedule to be completed by the end of 2022, with commissioning and production starting shortly after. Origin Materials is an exciting company with great long-term potential to 10x your investment. I am extremely bullish on Origin and hold it as one of the biggest positions in my portfolio. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.